Hello, welcome back. So it seems like Amazon is potentially saving the stock market for now, and definitely the Nasdaq. After Facebook really plummeted yesterday, lost about 26% or so in a massive drop for a company like Facebook. And we made a video about it, discussed Facebook, and discovered that it's actually pretty undervalued right now, and it makes for a potential interesting buy. But in this video, I wanted to talk about Amazon and its blowout quarter, or at least it was supposed to be a blowout quarter, but we want to be reading between the lines a little bit and actually really understand what happened there and analyze the company a little bit and the stock price, see whether it's a potentially interesting opportunity for us to enter here. Before we continue with this video, if you are new here, please leave a like and subscribe if you like this kind of content. And I'd love to see you in our Discord channel. You can find the link in the description box below this video. Okay, so Amazon says here profits nearly doubled to 14.3 billion, boosted by Rivian stake, and that is key here. The company also hiked its prime fees. I believe it's going to be up about 17 to 20%, something of that sort. But it's very interesting that the net income of the company was really boosted by the Rivian stake, which was an IPO, and right now it's down 40% year over year. And that's very important because in the next quarter this is going to affect Amazon's bottom line, and they will have a pre-tax loss. And bear that in mind, because this can actually really cause the stock to go down in the next earnings cycle. Now, you will see here that the company announced a $20 increase really in its annual Prime membership fee. And I have to say that I'm a big fan of Prime. I used to have it when I was living in the US, not living there right now. But it's a good service. And the other interesting thing here is that the Amazon's overall operating income did not reflect the increased value of Rivian. So it's basically about what they used to be doing before. So it was nearly cut in half. That's not a good sign here, to 3.5 billion from 6.9. Now, Amazon's web services were the star here, and they posted a 17.8 billion in revenue, up almost 40%, as you can see here. And you will see it in multiple articles here that Amazon would have posted a 1.8 billion operating loss actually in Q4 2021 if it wasn't for Amazon's web services here. Very interesting thing as well. So this is very important to actually realize that one of the massive reasons why, for instance, you see here that the earnings per share of the company were 27.75, more than 3.70, which was the expected earnings per share. That's a massive increase. It actually was boosted massively by the Rivian investment. But again, remember that Rivian is actually down 40% right now, year over year. It was an IPO. So this is very interesting and caused the Amazon shares to be up about 15 actually right now, 15% in after hours. We'll see how that goes when the markets open. But the quarter of Amazon wasn't really as much of a blowout as it seems to be, and as the stock price seems to infer here. That's not really the case. There are some troubles here. And if we go back at Amazon here and take a look at our trusty tool here, which we're using to examine the company, actually the company went down almost 8% the previous day just because of Facebook for the most part. Everything in the Nasdaq was severely affected because of Facebook going down massively. But interesting to notice here that the outstanding shares of Amazon keep rising. And that's obviously not great because the company seems to be funding itself through, at least also through selling stock. And it's almost identical every month or so. They seem to be increasing stock the same way a retail investor should be buying stock, really, like every month or so. And that's not great. At least it's not a massive increase. It's a very low increase over the years. That's at least good. It's a small increase in terms of percentage really over the years, but it's still, I would want them to buy back at some point. Probably doesn't make a lot of sense to buy back now because the company's stock price is potentially overvalued, sitting at a forward PE of 75 here and a current PE of 54, conveying the message that things are gonna get worse in the future. A price to book of 11 over here, almost 12, is a relatively high one, but we have seen higher. And the stock used to be actually more than almost 4,000 here. I'm expecting Amazon, and I would think that at some point they would want to do a stock split here. The price of the stock has really grown, and it can be a little bit of a deterrence for retail investors. This kind of a high price here. Maybe they want to split like Google did, like 20 to 1 or something of that sort. Now, if we take a look here at the history of the income statement of Amazon, you will see here that Amazon's year-over-year growth used to be 30%, 20% here, and 37%, 31.62%. And now it's projected to be less. So it looks like Amazon is losing some of its steam, and that's important, really. And this is something that you need to bear in mind, because generally speaking, the street doesn't like that at all. It really looks on growth, like it really feeds itself on growth. And so when a company loses some steam, that's something that can really hurt them in terms of their stock price. And don't be thinking that just because the company's stock price is going up 15% here, this is going to be happening forever. So we need to be taking a look at what's going on with the company. And you will see here, and we have talked about Amazon before, that the company has been growing its net income. And again, you will see that they posted an amazing net income right now just because of Rivian for the most part. It was massively overblown because of the Rivian investment. But that's not sustainable, so be careful about that. And the total liabilities of the company are sitting at $262 almost billion, $262 billion. And the total equity of the company is sitting at 121 almost billion dollars here. Now, the most interesting thing, the cash flow, and the cash from operations here has been high, but again, it looks like it's getting less and less as the years progress. So be careful about that. I mean, seems to be a little bit of suppression of income for Amazon right now. Now, the thing is that they keep investing a lot of money, and you will see actually if you take a little bit of a closer look at their income statement and cash flow, you will see that they are actually spending a lot for capital expenditures, and this is why you will also be seeing some suppression in their free cash flow in the next few years. At least that's what they mentioned in the earnings report. So, what's going on here? The free cash flow of the company, 6 billion, 17, 21, 25, and -2 here. Now again, this comes back to show you that they are spending a lot in their expansion. And if you actually take a little bit of a closer look, you will find all the details about why the company is actually, losing money here in terms of their free cash flow. And that has to do with capital expenditures. Whenever you see a negative cash flow from a company that's actually making a lot of money overall from their operations, it's all about capital expenditures, and you will see it here. It used to be 12 billion, like 13.4, 16.8, 40 in 2020, and 57 in 2021. So, this is good and bad. I mean, it's generally speaking a good idea to obviously invest in your capital expenditures, because it means that you are more than likely are going to be using that to achieve more growth over the years. And so it can be a good sign, but still, I mean, that's a massive increase in capital expenditures here, and brings down the overall free cash flow. And you'd have to account for that. And when you calculate the actual price to free cash flow, you do have to account for that. This is the odd one out, and usually this would be at around $30 billion right now. So don't think that Amazon is actually losing money because its free cash flow is $2.2 billion. You have to look into what happened and why actually they're doing that. And they're doing that because they know what they're doing. It's not like they're losing money from operations. That's the key here to understand. Now, that said, let's take a look at solvency, see how much debt the company has when you compare it to equity. Seems to be increasing. Now, at some point they were removing debt, seems to be increasing now. But again, it's a company that can incur a lot of debt. I mean, it's a highly leveraged company. We know this about Amazon. They keep expanding and increasing their growth, really. So I'm not like super scared of that. I do want to examine again, like if we take a look at the balance sheet so that at least I have an idea. Remember, we took a look at the balance sheet when we saw that the total liabilities of the company, total liabilities, by the way, is everything that the company owes to people. It could be suppliers, it could be debt, it could be everything. It's everything really, every cost that the Amazon has to pay at some point. And that includes current total liabilities and long-term total liabilities. The current ones are the ones that need to be fulfilled in the next 12 months, and the long-term are the ones that that need to be fulfilled over multiple years. And so you'll see that Amazon has been taking a lot of debt, and right now it's sitting at $262 billion. Now, their cash flow is about $30 billion. So that's a lot of debt. I mean, they're having quite some debt here that they need to fulfill. It's like 8 to 9 years of debt. That said, I'm not too worried about that, probably not worried at all, because the company is doing that on purpose, and it's a matter of management, really. And so I'm not against that as long as the company achieves growth. I'm a little bit worried because they seem to be losing steam. That's the only thing that I'm a little bit worried about. So, realize all this information, just understand what's going on, and if you wish to invest, know that this is what's happening with Amazon right now. Now, in terms of the actual market cap of the company, it's 1.4 trillion, and it's going to be more than that. It's going to be 15% more, it looks like, or even 20% more. So you're going to be looking at what, like 1.6, maybe a little bit more, 1.7 in terms of her market cap. Now, is that justifiable for entering the stock here, for buying some stock? The way to justify it in terms of the valuation is, apart from the PE, which can be a little bit deceiving, especially after the Rivian thing, I want to be taking a look at the free cash flow. That's what I want to be examining, and I'm gonna exclude this one. I'm gonna consider this to be 30 billion, and I'm gonna inflate it a little bit. I will perceive it as a $30 billion free cash flow company here. If you give that company a multiple of 20, you are arriving at $600 billion for its market cap. And right now we are looking at 3 times as much of a market cap. And this means that we are looking at at least 60 price to free cash flow ratio here, which is very high for my liking. And I love the company. Company is awesome, doing well, achieves good profitability here, good return on equity. They have a lot of debt, so that could affect that return on equity, by the way. But their multiples actually are pretty good. Like, their price to sales is pretty good. They're selling a lot. So yeah, this is fine. Yet I mind the free cash flow a lot. I'm an investor that really ties his investments into free cash flow, and so I want to be getting Amazon at a much lower valuation, and actually not spend that much based on how much the company is making in terms of free cash flow. So right now their price to free cash flow is, again, as I mentioned, is about 60 to 70 really, and that for me is very expensive. Remember, we are purchasing a company not just because they're going up in price and they are selling a lot. They have to be cheap for the money that we are spending for them. Like, a thing could be worth $100,000, but if you spend 120, it's not a good investment. Like, you need to be spending at least that amount, like 100,000 or less. So at most that amount or less. And so you need to bear that in mind. Every company is all about its cash flow in the very end. It's all about how much money they're making. And so the way to calculate whether you should be buying at a certain price is whether it's overpriced or underpriced based on its current free cash flow, for the most part. Now, there are other things as well, and it's about, obviously, it's about growth, for example. It's about revenue. It matters how they can sell and if they can sell. So there are a lot of things that come into play, but in the very end of those things is about how much money they're making and what is the return on the capital, really, that they are deploying. Also important. So that's what I wanted to mention about Amazon. Just wanted to give you the full picture here. If you wish to invest on Amazon, best of luck, and I hope that you are gonna be doing well. The company is a great company, but for me, I would want to get it at a lower valuation. That's it. I mean, again, I love the company. I want to buy it at a cheaper price. So I hope you enjoyed the video, and thank you for watching. I'm preparing a lot more today. There's a lot of action in the stock market. It's gonna be more on Nvidia and PayPal and Palantir. I'm going to be talking about those in separate videos. But if you enjoyed this one, you may want to take a look at the video that I made earlier about Facebook. Very, very interesting story here unfolding. And I'd love to see you on Discord again. Take a look at the link in the description below. Thank you for watching, and I'll see you in the next one. Bye bye.